Alright, what's going on my stock market bulls and bears? I'm your host Terry and welcome to the channel Buy the Dip. Guys, got a pretty cool video for you today. On CNBC, we have an article here. This tech company is about to report earnings and still has ample upside, long-term investor says. This was just published today, October 25th at 5 p.m. So literally by the time I'm recording this, it's not even an hour old and we are first on the news, baby. May not be first to see it, but I'm recording it and getting it ready to be queued up for tonight. So hope you guys enjoyed the video. And let's get here to it. So we have an interview here that I think we need to watch the interview and have little reactions to the video and kind of give our thoughts on what is said here. So let's get to it.
Welcome to Trading Nation. I'm Eric Chemi. A huge week of tech earnings, all while some of the group's biggest players face scrutiny from Congress. Alphabet, Amazon, Facebook, Microsoft, Apple, and a host of other big names gearing up to report their latest quarters. One top tech investor says a few of the upcoming reports are making him nervous. Let's bring in Paul Meeks. He's a portfolio manager at Independent Solutions Wealth Management. Paul, welcome to the show.
Great to be here, man. Always good to see you.
So, Paul, why are you so worried about earnings this week? Is it the company's performance, or is it something political, monopoly, Congress, regulatory, that kind of thing?
Boy, I'd like to say it's probably all of the above, but what we've seen in the early stages, and we're only in the early stages of this particular earnings quarterly season, is that some companies, if they are disappointing with either the actual results or with the go-forward guidance, are getting hit pretty hard.
And wanted to stop it right here and kind of show you, man, we have some big players reporting earnings this week with Microsoft, Akamai, Apple, and Activison Blizzard, man. So these are some big tech companies. I'm excited for Apple's earnings to come out on Thursday. I have me an Apple share, hoping to pick up another couple shares and increase my portfolio diversity with some Apple shares. So yeah, man, let's get back into the video.
Not worried about all the names that I own in my tech fund, but there are some, particularly since they've had big moves and outperformance in their stock prices, that probably, if there's any tinge of disappointment, could have at least a short-term correction. If they do have a short-term correction and they're still on my tech favorites list, I'd probably buy into that weakness.
So if you're not feeling good about it, you want to buy on weakness, do you sell on strength, right? Is this just a one-sided trade? I buy on weakness, or is it I need to really lighten up, give myself some powder so that I can buy even more on weakness?
That's a great question. I actually want to hold most of my names except for the near-term nervous ones. And again, if they disappoint and I still like them long-term, which I do, then I buy into that weakness. Now, on the upside,
basically, a quick update on this one. You guys are going to love it. What he just basically said there is to guys, buy the dip is basically what he's saying. If you, number one, believe in the company, believe in the management, and believe in the business model, he's basically telling you, man, to buy the dip, guys. That's basically, in other words, this was, he could have summed that whole thing up and just said, buy the dip. He could have just said it. But yeah, that's basically what he's saying there is to buy the dip. Let's get back to it.
I think that we may not be able to do it in the next 11 days before the presidential election. But if and when we do pass the follow-on stimulus package, then I feel much better about the economy, much better about the markets, and much better about tech. And at that point, I would actually advocate a risk-on equities trade, and your portfolio at that point probably should have a fairly large exposure to the tech sector.
Fairly large exposure to tech sector, even though they've run up so much. I'll ask, let me ask you that, and then I'm going to ask you about some specific stocks. So
as you can see there in that clip, guys, there was a lot of players that is going to be reporting earnings this week. So if you have those stocks, you definitely want to keep up on that. Let's get back in here and hear what they have to say.
So you say, have a fairly large exposure, but it feels like people do have a fairly large exposure to tech.
Oh, yeah, of course. I run a tech fund, so I'm tech fund all the time, right? I don't really have. But for somebody else who is underexposed in equities and underexposed within equities in the tech sector, which I think you should have, about 40% of your stocks in tech, it might be an opportunity to get in because, again, once we have the fiscal stimulus package, I am very bullish because the way I look at it is I know the temptation is to invest in some of these value stocks that have underperformed with the thesis that they'll come back to the norm. And the tech stocks that have outperformed will come back to some kind of normalized below price. But with real interest rates so low, and with growth so low, and with inflation so low, I hate to rain on somebody's parade, but I think that growth continues to outperform value. And I'm just waiting till we get through the election and the fiscal stimulus passage, and then I really want to emphasize that strategy.
Guys, right there he said it. If you watch my videos, it's what I've been telling you guys. Two key things that we're waiting for, and a lot of these companies are going to take off, is the stimulus and the election. Guys, I've been saying the same thing, and it's nice to hear someone else say that as well.
Paul, I know you like Adobe. That's one of your favorite names. Can you explain to our audience why that name in particular stands out to you?
So Adobe is a company that's actually one of these 80s titans. It went public in 1986, but went through a metamorphosis under a new CEO a couple years ago. So all focused on software as a service. But here's a company that spearheads digital marketing campaigns. And of course, they were on fire with a very aggressive revenue growth before COVID. But COVID in the world I see after COVID will only emphasize that more. And unlike a lot of my tech stocks, which have priced in a lot of the upside greatness, I still think that out of all the tech majors, this is probably the one that still has ample upside to the price target, which I still think is either 10, 20, 30% higher than its current price.
So that's the one that you really like, the favorite, let's say your most favorite there. Is there any one in particular, though, the opposite, that you just think, I'm not touching this stock, I don't care what happens with the election, this is just a no-go for me in terms of any of these major tech plays? Well, one of the things that I've seen recently, and I'm answering a lot of questions, like today, Intel is down 11%. A couple of days ago, IBM reported their quarterly results, similarly disappointing, down quite a bit. The same thing with Cisco, the same thing with Hewlett Packard. So I'm one of the few tech investors, given my experience and unfortunately my age, that have been around when those companies were great, and they've been such dogs. And some of them have very attractive dividend yields, like, for example, HP and IBM have dividend yields of 6%. So the temptation is to get back in. I call it the revenge of the nerds thesis. But the problem is when you do that, you get into a company that is a yesteryear company that is not in sync with global technology trends, and it usually just ends up being a value trap.
I wanted to stop here a second and kind of give just a little extra my 2 cents onto this. And basically saying to my LCA family here, man, this is what I'm getting in here. To my LCA family, all you guys worrying about the dip and everything that's happening right now. As he said, he's talking about Intel and IBM. Those guys been around for years. LCA GNOG is a brand new company that just came out. So they have plenty of years to prove their business model and growth. And the iGaming market is going to be huge. The iGaming market is going to be huge in the future. And the revenues, like I said, they make $25 million a month just in New Jersey, guys. So keep that in mind. If you're feeling down your LCA, man, and LCA is a tech stock. That's the crazy thing. LCA is technically a tech stock. So, and I think these tech stocks in the iGaming market is just going to blow up here one day, and we're going to see some great gains. But let's finish up this interview here.
So today, a lot of folks have been asking me, hey, let's get into Intel down 11%, and I say, no way.
Interesting. I like how you put it. I think we got to end it right there. Paul Meeks, always a pleasure to chat with you. Thanks for your insight today and joining us on the program.
See you, Eric.
That was Paul Meeks. Oh, yeah. There. See you later, Paul. That was Paul Meeks.
All right, guys. So that was a pretty nice little interview there that was done on CNBC, and I pretty much agree with it. Like I said, he's basically saying if it's a company that you believe in their, structure, business model, earnings, management, then it's of course a no-brainer to keep buying the dip. But if it's one that is a company that's been out and you don't see them on the cutting edge of new age technology, and they're like Revenge of the Nerds stuck back in the 80s, then you don't want to invest in those companies. But like I said, LCA is definitely not that. LCA is on the cutting edge of brand new gambling at your home. Like, guys, I could be here gambling at my home on my phone, like LCA. Like, literally, guys, I could be gambling there on my phone, LCA style, right here. So I think it's cutting edge. I think all these iGaming stocks is going to be just a brand new trend. I'm excited to be have a decent amount of shares in the stock because I think we're going to see some great growth. And one thing I did find out here that was pretty cool, I found that there's this earning calculator. It's on finscreener.com, and it can do weekly the earnings of which companies are reporting earnings. And here I found, Apple's reporting their earnings on October 29th. And yeah, UPS is reporting. So you can just get on here, scroll down the left-hand side, because this is where my arrow's at here. This is the ticker symbols that's all reporting. So yeah, you can just get on here and look week by week if you don't know which stocks is reporting earnings. Like Fiserv is right there. And who else do we got here? There's Microsoft reporting on the 27th. So yeah, it has everybody in here that you want to know. So it's a pretty cool website. I definitely highly recommend checking it out. If you want to know your company's earnings, you can type in their ticker symbol and pull them up. Also, eBay is going to be reporting. And let's see if we have anyone else here. Oh yeah, you said UPS and Apple. Yeah, so yeah, man, that's going to be it for this video, guys. Just wanted to bring you that interview and let you know what's going on here with the big tech and what's happening, man, and what people is doing. So, all right, guys, you found this video helpful. You know what to do. Hit the thumbs up. Join the Thumbs Up Nation. Guys, I will catch you in the next one. And remember to buy the dip.